we're very much stuck in the mud. I mean, so the Eurozone is now probably in a technical recession, right? I mean, it's very close. And I think, if you were just stepping up in the helicopter and looking at the Eurozone economy over the last sort of 4 quarters, growth is zero, right? In real term growth, the economy is going nowhere. And kind of every time we think, oh, maybe now something good is about to happen, it's zero.
You're listening to Macro Sunday, hosted by Andreas Steno. Happy Sunday, Merry Christmas, everyone, and welcome to the Macro Sunday podcast. I'm Andreas Steno, founder and CEO of Steno Research, and I'm all by myself this week as my lieutenant, Emil, is on paternity. So his son arrived through the week, and we wish him all the best. Over the course of the week, we've had interesting inflation prints again, both out of the UK and the US. And my guest of the week in 5 minutes' time, Claus Vistesen, is one of the best inflation watchers out there. And he's also a very avid watcher of the European Central Bank. I'm going to have a discussion with Claus on how to assess both the short-term dynamics in inflation, but also the long-term dynamics here. Because all of a sudden, it seems like no one truly believes that the underlying inflation level is much higher than it was pre the pandemic. The reason is that we've had soft inflation numbers again this week, starting with the UK CPI. We had that smack dab at our forecast. I think it was 0.3 percentage points off the consensus. And it was basically a very, very soft report across the board. We had services printing at minus 0.15 month on month. That's a sharp change of scenery to what we've seen over the past couple of quarters. We have goods printing at almost minus 0.4. We have transport almost printing at minus 2% on the month. And you find very few outliers in the other direction outside of food and housing, water, electricity, and gas. So I think it's safe to say now that inflation has come down faster than most people had anticipated 6 months ago, especially the change of scenery in both the UK and in the Eurozone is quite dramatic here. And we also now have a market pricing of softer European central banks relative to the US. And I think that's very fair. We also see more of that upcoming into the first quarter of next year, not least due to extreme forecasts from the European Central Bank. We'll get back to that with Claus Vistesen in a second. Then we also had the PCE report on Friday out of the US, and it was essentially a report that looked softer than the CPI due to the various weights in the two indices. And on top of that, it also felt like it was very flagged up front, this weakness or this softness in the report. All major IBs basically toured with a very soft inflation forecast for that PCE print, and it delivered at 2.6% year over year, just barely. We had 2.7 in our forecast, but it missed by 0.01 in terms of rounded figures. Enough about that. The whole point here is that inflation keeps surprising to the downside currently. Except for the US CPI, we've had downside surprises to write about everything in inflation space over the past month. And when we pair that with growth holding up okay, it almost seems Goldilocks-y. Adding to that, we have a situation where dollar liquidity keeps improving as a consequence of the overnight reverse repo facility being depleted very fast right here. And if you look at the issuance calendar over the next, say, 4 to 6 weeks, I would actually expect the depletion pace of the overnight reverse repo to pick up momentum, meaning that net dollar liquidity will be added, and dollar liquidity will, by the way, be very ample over year turn, which is a bit out of the ordinary, at least if you look at it on a 10-year scale. So interestingly, we have inflation surprising to the downside, very duration positive. We have liquidity surprising to the upside, very duration positive. And then we have growth holding up okay. Um, it's not a miracle, but growth is at least doing less bad than feared, especially when you look at it in the U.S. economy. So, is inflation gone as a topic? I'm not necessarily sure. Remember that it's cyclical. Remember that we have volatility in inflation now, meaning that cycles will be exaggerated. And listening to the true president of the United States, Mr. Donald Trump, on inflation, he's probably also of the view that it is something that should be addressed on a running basis. Here's Donald Trump on inflation a year ago.
We will immediately tackle inflation and bring down to a level that it was. We were at 0, but actually the best number is 1%. Do you know that? You don't want it really 0. But we were at 0. We actually got it to exactly 1%, the perfect number. One thing every economist agrees, don't have it 0, have it like at 1%. They even say 1 to 2, but I said, let's do 1. And we had it at 1%, and we had it there for a long period of time, and we had the value of the dollar. We had it so that this country could make a lot of money, and I fought other countries where they devalued their dollar, or they devalued their currency, whether it was the pound or whether it was the yuan or the yen. And I used to fight like cats and dogs with the leaders of other countries because they were stealing from us. When they did that, they had artificial devaluations of their currency. It's a very important thing. I haven't even heard it mentioned in 2 years. That's a very important thing. It's very hard for us.
We'll turn down Donald Trump these words. I think the 1% target is a newcomer. Actually, all that at 1% target for some very weird reason. Such a target anywhere. But in any case, inflation is probably here to stay as a topic. And I think Claus Vistesen of Pantheon Economics is one of the best sparring partners you can possibly get for a discussion on whether inflation is here to stay on a trend basis and whether we should gear up for inflation surprises in the opposite direction of what we've been accustomed to over the past couple of months here when we look 6 to 12 months ahead. And as per usual, we introduce our guest of the week with a piece of music. And Klaus is Dane, as I am, and he loves Nephew, apparently, a Danish band. And here's the song Super League, in Danish, Superliga. Great timing given the Super League back in the limelight this week. To reintroduce Claus Vistesen of Pantheon Economics to the Macro Sunday podcast. We've hosted Klaus before, and Klaus is one of the best ECB watchers I know, so it's a great pleasure to have you back, Klaus. Great to see you.
Thank you.
Klaus, we've had plenty of action in interest rate markets after a month of meetings at central banks, and the European Central Bank sounded a little bit different to the very dovish vibes from Jay Powell and the Federal Reserve. How do you read the European Central Bank at this juncture?
So I think the European Central Bank is trying to send one message to markets, right? And that message is basically that now we're done raising interest rates. The problem for the ECB is that markets are way ahead of them. I mean, everybody in markets knew all the way back to September that they were done. Because remember, the September hike was very controversial. So, I mean, everybody knew that that was the end. And so even though the ECB was still at that point talking about, we might raise interest rate again, nobody believed them. And so now they're in the situation where they're saying, okay, we're done. That's the key message. But markets, again, are way ahead of them, starting to price in and discount rate cuts in the first half of next year. At this point, the ECB is not happy with that. Clearly, that was the message that came out of the press conference, and it was more hawkish than the Fed in terms of pushing against market expectations. But the way the inflation data are coming in, and certainly the way I think the inflation data is coming in, I mean, I think it'll be very difficult for the ECB to maintain that position over the next 3 to 6 months. But I'd say inflation at the beginning of the year is going to be key because that's going to set this sort of the tone for overall inflation next year. But basically, the ECB is sort of one step behind markets. And obviously, right now, they're finding it quite difficult to steer market expectations because, the data is just not mean, they're overestimating inflation, right? And so the markets are kind of sort of calling them out a little bit.
Markets really started to price in cuts after the speech given by Isabel Schnabel, the German member, a few weeks ago. It was kind of seen as a pivot of the overall trajectory of the ECB policy. Do you find that speech to be as relevant as markets did?
I mean, it was a pivot. I mean, Isabel Schnabel has been a proponent of a relatively hawkish stance, and she started that speech, with when the facts change, the quoting Keynes, right? In a way, there was a pivot. Now, I think if you ask Isabel Schnabel, she would say the pivot is we're now done raising interest rates. And going back to my point is that markets are way ahead. I think that the ECB is not as such against the idea that rate cuts may come next year, but they're certainly trying to push back against the idea of rate cuts in the first half of next year, right? That's kind of like where we are at the moment. But again, for example, when Lagarde said she I mean, you referred to this in one of your earlier podcasts about the difference between liquid gas or whatever, and they're using very odd metaphors here, right? I think when Lagarde says that, she made the point that when you reach the terminal rate, which they've reached now, they have time to enjoy the view, or they have time to stay there for a while. That was kind of like the message they're trying to send. They want to stay here for a while. But I mean, I think history shows that once you get to the terminal rate, and in particular if you are almost, perhaps 200 basis points restrictive based on your own estimates of neutral rate, I mean, you're not going to stay there for long. I mean, inflation is going to come down. Inflation is now turning, and I think it'll be difficult for the ECB to maintain that position. But let's see what happens with inflation at the start of the year. But right now, I think that they'll find it difficult to hold that line.
So, Claus, if we look at inflation in the Eurozone, I think we've had three very dovish outcomes of the inflation reports in a row, between 0.3 and now even 0.4 percentage points below consensus a couple of the months. So what do you make of the inflation outlook into the first quarter? Will it be very wage driven as the ECB thinks, or?
No, I don't think wages are driving it right now. So in the very near term, so next time we're going to get the December report, and you're going to have some base effects there due to a one-off fiscal policy stimulus in Germany last year. So energy inflation is going to snap back, headline inflation is going to come back, but I think core inflation is going to fall further. But the real the real litmus test for my call of low inflation, and in general the whole trajectory of interest rates in the first half of next year, is going to be the January print. If you look at the ECB and their forecast, they're basically assuming, like we've seen in the last couple of years, that January is going to be this one-off adjustment higher, utility prices are going to adjust higher, menu costs are going to adjust higher. There's going to be sort of a lagged effect from the shock in which inflation adjusts higher, and therefore they have a quite steep, even a rising inflation profile in January. But I don't think so. And if you look at what happened in November, if you extrapolate the current trend, inflation in the Eurozone is going to be 1.5% by February. This is now well within. This is not like an outlier call anymore. This could well happen. And the ECB, I think, is still forecasting inflation to average almost 3% in the first quarter, right? So they could end up being like 150 basis points off here. And obviously, if that happens, they'll have to shift. So this is kind of like what I'm looking at the moment. But that January inflation print is going to be really important because it is really difficult to call, right? Fiscal stimulus, some fiscal subsidies are rolling off. There's always a lot of uncertainty about inflation at the start of the year. The weights will change. There's a lot of uncertainty. So we don't know. But I would say that after that November print, we're now in a situation where inflation genuinely, by February, could be well below 2%. That's well within the realms of possibility at this point.
Given that inflation view, Claus, is there a feasible path to a rate cut already in March?
Oh, I mean, that's our forecast, right? And to be fair, that is sticking our neck out a little bit because that they would have to pivot quite significantly. But if our inflation forecasts are right, the ECB's March forecasts are going to be a dovish washout, right? They're basically going to have to rip up the script completely on what they've been seeing so far, at least we think, and therefore they might. Why would they wait? Why would they wait cutting interest rates? Wages are definitely the counterpoint here because the ECB continues to emphasize wages. And that could take us in a completely different direction because if the ECB is now basically targeting wage growth or looking at wage growth, look, I mean, they might not cut until the end of next year because wage growth are so long lacking in the Eurozone that it'll take a long time for wage growth to come down. But our view is that once inflation comes down below target, right, the high wage growth become less important because again it's a lagging indicator. But again, we can't be sure about that. So we need to see how they respond to the January inflation print for sure.
And Klaus, if we add the most recent growth gauges to the mix here, both the IFO number out of Germany, but also the PMIs from, for example, France, how do you view the growth picture into the first quarter of next year? It seems like we're stuck in the mud here.
Oh, we're very much stuck in the mud. I mean, so the Eurozone is now probably in a technical recession, right? I mean, it's very close. And I think, if you were just stepping up in the helicopter and looking at the Eurozone economy over the last sort of 4 quarters, growth is zero, right? In real term growth, the economy is going nowhere. And kind of every time we think, oh, maybe now something good is about to happen, it's zero, right? So right now, again, going to your point, I think there was this idea that maybe growth would start to perk up a little bit in the first quarter. Real incomes are rebounding. Consumer spending is coming back. Maybe, but as you say yourself, the surveys coming into the first quarter suggested, look, we're just going to have zero again in the first quarter. It's going to be very weak. Risk is tilted to the downside. I mean, the only thing I would say from the point of view of the ECB when they're looking at these numbers is that obviously the labor market hasn't really cracked yet, right? So it's not like there's this huge sort of shift in the economy beyond obviously weak surveys. But I mean, it's not the Eurozone economy hasn't gone anywhere for 12 months, 18 months, and we could go further on that story for sure.
Klaus, given this cocktail of lower than expected inflation and very weak growth in the Eurozone, the next topic I'd like to discuss with you sounds kind of odd, because a couple of weeks ago, you and I had a chat about the potential for a reacceleration in inflation, say into 2025, maybe even 2026. And you made the case to me that it is actually a pretty compelling argument that inflation expectations down the road are too low, despite this short-term discussion. So why do you think so?
Yeah, no, so I think this is really important. Right now, most inflation forecasts, even swaps by markets, have this linear decline in inflation, right? And I can understand why that is. But I would argue that if people who are listening to this, they're obviously very capable people, if they sat down for 30 minutes or sort of looked at the actual inflation numbers, just try to draw some trends and with month-to-month prices, try to sort of do their own forecast, they would see that when you come off a shock, we've had a really, really significant shock in inflation, right? Inflation almost 10% significantly. What tends to happen if you just extrapolate is that inflation will undershoot. And this is where we are now. Inflation is falling very quickly. It probably could undershoot in 2024, especially in the first half, but then it starts to come back up. And an inflation shock, like we've seen, really has two components, right? There's the actual shock, which we've now gone through, and it's fading, and you could have an undershoot in inflation. But then, as you start forecasting inflation into 2025, 2026, obviously nobody knows what happens in those years. But if you're forecasting based on the trend, in a way, your forecast carries that shock with you, right? We've had a long period now where prices have increased faster than normal over a long period of time. Wages have gone up. Again, there's been inflationary pressures in the economy, lots of demand, supply side shocks on the negative side, and so you carry that inflation forecast through. And so, and again, one of the things we talked about, and in general, the discussion we're having with people and clients in general is that the difference between a soft and hard landing is really this sort of where does inflation stabilize? If we can get inflation to somewhere around 2% and we can keep it there, of course, everyone is happy. But is that inflation going down to, let's say, 2%, and then towards the end of 2024, maybe middle 2024, end of 2024, starts reaccelerating above 2%? What do central banks do? 2.5%, is that okay? Can we stay there if rates are still relatively high? Maybe that's a stable equilibrium, but I don't know. And I think really at this point, again, like I said, if you just sat down 30 minutes and looked at the numbers, you would realize that there's a really high risk that inflation starts to reaccelerate again towards the end of 2024 and goes back above 2%. And again, suddenly we're then in a situation that, are we starting to raise interest rates again? Will markets start to price in for the tightening? So that's really interesting. But for now, of course, I think we're in an environment where inflation continues to fall quite rapidly in the near term.
But Klaus, if we look at forward-looking evidence on inflation, and that's easier said than done, are there any signs in your models of an actual reacceleration of the sort of underlying trends, say, into the second half of 24?
So in Europe, I would say yes, right? Because Europe is probably the region, the major region which has undergone the most significant shift compared to before COVID, right? Before COVID, you had a long period of basically fiscal discipline. You could call it austerity, but you had fiscal policy was bruised coming out of the sovereign debt crisis. You know, they got really stung, and you had a really high unemployment rate for a really long time that had to work its way off. Now we're in a situation in the Eurozone where fiscal policy has suddenly become much more activist, both during COVID and also during the energy crisis. We've come up with new automatic stabilizers. We're paying people to stay at home. You know, these things I think these things are here to stay in a way. And also crucially in Europe, which is absolutely, fundamental, the labor market hasn't suffered at all. I mean, if you had asked any Eurozone economist before COVID and saying, we're now going to have a drop in output of like whatever, 20%, and then we're going to have an energy price shock. I mean, they would have said, look, unemployment is going to go to 13%. But we're at a record low, right? Still, I mean, unemployment rose a little bit, but then, fell back again. Firms have been sticking with holding on to to labor. So, in core inflation was trending in the Eurozone before COVID at about 1% because of that disinflationary, deflationary, maybe cyclically speaking, but also perhaps structural coming out of the financial crisis, some of that crisis. And so there's still a structural story. Demographics disinflation, this whole structural story, right? But if you look into the forecast horizon for markets, 2024, 2025, maybe even 2026, yeah, I think we are in an environment where the Eurozone inflation, particularly European inflation, but perhaps also inflation elsewhere, has kind of been lifted because of this, right? And again, maybe that's not such a bad thing. Higher inflation, nominal growth is higher. We can deal with it. That means that the real value of debt gets eroded. Maybe that's not such a bad thing. But I think in Europe, you can make that argument for sure. Yeah.
If we look at inflation forecasts, say 2, 3, 4 years ahead, I know it's a very, very tricky exercise to look so far ahead. Do you have any strong views on how you actually perceive risks to the priced-in inflation over such a time horizon, Claus?
No, I mean, obviously that's very difficult. Like I said, like I said earlier, if you actually sit down and try to forecast, basically extrapolate some of the assumptions you might have, and you go all the way out to 2026, 27, something like that, very, very far out, right? I think the first message the data will tell you is that this idea of a linear decline is unreasonable. Actually, what's more likely, you get an undershoot and then an up, right? So that's the first message you would get from an exercise like that. And then there's obviously sort of, like you say, where are risks tilted? Well, I mean, so from my perspective, I would say, apart from the reasons I just mentioned, where labor markets are relatively tight, we have more activist fiscal policy. I mean, geopolitics are inflationary now, right? I mean, we're in an environment now where there's geopolitical tensions. Trade is suddenly not as seen as sort of this, political benevolent thing anymore. Nearshoring, friendshoring, global supply chains, which we have to kind of rejig. All this is inflationary, right? I mean, and because really, it's the post sort of, if you will, end of the Cold War economy where everybody's free trading, and that's a disinflationary economy. The Chinese labor force comes in, all that stuff. I think all these kinds of structural trends that we've known, they're now being questioned in a way, right? And we don't really know whether we have to completely discount them, because obviously these are big questions and we can't really sort of just sit here and say, oh, we just dispense with them. But I do think that, like, especially the U.S.-China relationship for me is a global inflationary thrust now, because if the Americans are really serious that there are simply things that you can't have based in China anymore because of like security concerns or something. Yeah, I mean, the Americans can do a lot by themselves, but it's going to cost more, right? I mean, it's just like, it's going to be more expensive. And in a way, that's kind of like, that's going to be the price they pay, I think.
And maybe the safest conclusion from such a discussion, Claus, is that inflation volatility and rates volatility will be higher than what we've been accustomed to.
No, absolutely, absolutely. And just again, I mean, to that point, if you were concluding, you would say before COVID and all this stuff we've had, I mean, yeah, the US had an interest rate cycle, kind of. I mean, we saw the Fed try, but again, there was this sense that, every time the Fed trying to raise interest rates, something would happen and they would kind of just be knocked back down, right? There was no interest rate cycle in Europe, and there was no interest rate cycle in other countries, really. But now we have interest rate cycles, right? We've got the countries doing different things, countries getting different input from their domestic economies, and you have interest rate cycles again. So again, I mean, yeah, if you're a macro trader, I mean, and you're trading fixed income and currencies, I mean, yeah, all power to you. I think, there's a lot more elasticity in the system now for people to make money and lose money, but that's another question.
But Klaus, ultimately, this increased inflation volatility, how do you navigate that as a central bank? Because I guess you dislike inflation volatility as a central banker.
Absolutely. And again, going back to one of the things I mentioned, one of the key questions central banks need to ask themselves over the next 12 months, I think, is that, yes, inflation's coming down. They're probably going to reduce interest rates a little bit. But then if inflation stabilizes at 2, and then it starts to go back above 2%, do they then chase that higher and start to raise interest rates? Or can central banks get to a point where, let's say in Europe, you get to, let's just take market pricing at face value and said the policy rate in Europe is going to go to 2.5 to 2.75% over the next sort of 18 months. And let's say you have a situation where inflation is sort of bopping up and down, it could be 1.9, could be 2.2. I like to believe that the ECB could just maybe stay there without having to chase every little move. But again, to your point, the volatility itself means that it's very difficult. It's going to be very difficult in real time to see whether a move in inflation, let's say 1.8 to 2.3 to 2.4, is that a new trend? Do we have to respond to that? Yeah, it's really difficult for central banks because, quite frankly, I don't think they or me or you, I don't think we have any good model to predict whether a shift in inflation like this ex ante is going to be the beginning of something. It's very difficult, obviously, in real time to predict that. I mean,
It truly is. And Klaus, the final question I want to ask you is a question that I've received from several clients of mine and also sparring partners. I think I lean the same way as you on euro inflation ahead of that March meeting at the European Central Bank. But can they cut interest rates before having evidence of the Federal Reserve moving in the same direction? Do they dare to move ahead of their peers?
That's a fair question. So interestingly, just to get the actual, to get the dates right, the ECB meets before the Fed in March, right? But I think they can. I mean, they've said they can. So I think if the evidence is very strong in favor of them cutting, I think they can cut, especially if their own forecasts really shift, right? But it would definitely help them, I would say. Let me put it like this. It would help them if by March, the Fed rate cut is a lock, right? Let's say we get to March, we've got all the non-farm payrolls and all the US CPI numbers and the ECI and all the data basically supports the Fed cutting rates. Yeah, obviously it'll be an open door for the ECB to walk through, right? If it's more uncertain, that might still affect them. I mean, I, for example, think they were very surprised with the dovish pivot by. I mean, clearly that caught them off guard. It was the day after, and suddenly they sat there and going, "Oh my God," and so I do think that matters. But for our part, I think actually, we're moving towards a Fed rate cut in March as well. I think that's our forecast as well with Ian Shepherdson. I mean, they're working on it at the moment, so don't quote me on that. But I think it's close, right? So again, it is lining up, but who knows? I mean, I do think that it would help them if they had a clear indication that the Fed was definitely going to go.
And maybe they will get one directly from the Fed. That's not 100%.
We don't know, of course.
Yeah. Klaus, it was a tremendous discussion, and I can guarantee you that I'll call you again in a couple of quarters to discuss this potential new kink in the inflation path out of Europe. It will be a very interesting year, I think. I think the tails are very fat in macro for 2024, especially given the uncertainties around the path 12 months ahead for inflation. So thank you very much for being with us again. It's always a pleasure to host you.
No, thank you very much for inviting me. I enjoy it. It's a great podcast. I listen to it every week. So, anytime.
Take care, Klaus. Back in the studio after the interview with Claus Vistesen of Pantheon Economics. Very interesting discussion on the divergence between the very short-term outlook for inflation and the medium-term outlook for inflation. I very much agree with Klaus that we have various forward-looking indicators pointing towards reacceleration in inflation by, say, May or June next year and into the second half of the year. And I guess, given how market pricing looks across various OIS forward curves, it would be quite a game changer if inflation actually started re-accelerating by early summer next year. I'm referring to service price surveys. I'm referring to the NFIB price plan survey in the US, and such gauges of survey price services price pressures 1 to 3 quarters ahead. We do see those surveys bottoming out, and it's more or less a global trend now, um, which is an interesting signal because it could basically mean that the stickier components of the inflation basket will struggle to get to 2%, and especially if the deflationary and disinflationary effects from goods, if those effects wane, then it's obviously an issue if the sticky parts of the basket remain sticky. And judging from the PCE report released on Friday, we have goods printing at minus 0.72 month on month, and services still printing at 0.25. Pretty soft, but still, well, some room away from the actual 2% target. So goods are doing the heavy lifting here, while services are slowly but surely converting to target. But there are signs in forward-looking measures of service inflation of a reacceleration into the second half of 2024. We will leave it at that for this week. We remain long duration, we remain long utilities, and we remain short euro dollar, on the hopes of a softer ECB relative to the Fed. The inflation discussion is very interesting here in Europe. The December print is not necessarily the print that will look soft, but January, February in particular will look soft, also according to our guest of the week, Claus Vistesen of Pantheon Macroeconomics. My name is Andreas Steno. Remember that you can find a truckload of information at stenoresearch.com. We have inflation models that have proven very, very accurate over the past 4 months. We have positioning data, flow data, all of that readily available in our data hub. And on top of that, you obviously get access to our live portfolio, our articles, and all of the good stuff at stenoresearch.com. Remember, there's a 2-week free trial if you're interested in following us. With those words, Merry Christmas, and I'll see you again next week.